Rajeev Radhakrishnan, CIO as Fixed Income SBI Mutual Fund, is now with us. Rajeev, firstly, thanks so much for taking out time for us. It's great to get perspective from you, especially at such times. Did you think that the yields in US will be so high? Dollar index will be at the level at what we are? And what does it mean for Indian bond markets, Indian currency markets?
Yeah, good afternoon. So, you're right at the outset, which you refer to the move in bond yields and the dollar index. So, some of this or this magnitude of move probably wasn't anticipated a year back when most central banks were parroting the narrative of transitory inflation. But the reality is that the bond yields, the way developed market central banks have reacted, that will have a lot of spillover effects on all emerging markets, including India. So even though our both external sector buffers and our relative macros are relatively better, we still do have to deal with these spillover effects, and that's something that we are already witnessing, more so in the currency markets in the recent weeks.
When we just talk about really how things are moving in and what's happening in, earlier rupee did show a lot of strength, but now it's going ahead as far as other emerging markets or what's happening to dollar index is concerned. So you think that this can continue for a while? If this happens, what does this mean for a lot of FI investors, even into bond markets?
Yeah, so the reality is that when you look at the movement of the rupee over the recent, maybe over the calendar year so far, or ever the Fed actually changed its policy stance, we've been relatively, I would say, well contained in terms of depreciation compared to most of the other emerging market peers. And I think that's got to do with the fact that, one, our macro factors are relatively better. And second is the extent of intervention that the RBI has been able to do. And that is to a large extent a function of the amount of reserve buffer that we had built up when flows were coming in. And to a large extent, I think directionally, it's very, very unlikely that the rupee would stand out in the face of a very strong dollar. And I think that is something that will continue to impact markets as we go forward. So to that extent, investment, I think intentions of offshore investors into Indian bonds to a large extent would be a function of their expectation on the currency movement as well. But the reality is that we don't have much of offshore investment in Indian bonds at this point in time. So the outstanding today is probably, I think, less than 2% in government securities of the overall outstanding stock. So I don't think we are really vulnerable with respect to any potential offshore selling in Indian bonds.
So one is, of course, offshore Indian bonds. Second, whenever you look at the yields moving up so sharply, if we are so high in terms of yields, what sort of picture does it have for equity? Because you would come ahead and say that, earnings are expected to grow, say, 9%, 10% next year, and bond yields are at about 8% or 7.75. So when that happens, that reset, what does that mean for bond market, currency markets?
Yeah, very clearly. So when you look at earnings yield as compared to bond yields, very clearly where we are today, the case for investment in sovereign bonds is very, very, I would say, very clear cut and very apparent. So I think there's a very clear argument for incrementally looking at investment in bonds, even accepting the fact that as we go forward, there is likely to be a little bit more of volatility, given that we are still in the tightening phase. But where we are today with the bond yields at almost 7.5, I think there's a lot of degree of comfort in terms of, I would say, incremental investment into bonds. And I think to a large extent, the relative allocation between equities and bonds will definitely be influenced by where bond yields are today at this point compared to where earnings yield is expected to be. So I think that's the factor that will always be part of investment in a multi-asset allocation portfolio.
When we look at the emerging markets, it's clear that India has stood out in terms of bonds, in terms of equities, in terms of currencies. But, people are taking a hit as far as Russia is concerned. China is going down quite substantially. So, for how long can, flows be insulated from the Indian bond markets?
As I said earlier, we haven't seen much of flows coming into Indian bond markets maybe over the last 3 to 4 years. The outstanding, the investment, as I said, in government bonds is less than 2%, and there's a lot of, headroom available. Uh, I think one of the factors beyond currency dynamics that offshore investors into Indian bonds look at is where real yields are, or the expected real yields are. So we were in negative expected real yield for a long period of time. But I think as we stand today, given where the yield curve is and where the expected 1 year ahead CPI inflation is, which is about five quarter, there is real yields available across the curve. And I think as the overall external markets settle down at some point, once the Fed and the other developed market central banks are done with their tightening, I think emerging markets where there is a fair degree of comfort on real yields, and again a fair degree of comfort on the currency side, and I am sure India would be one among that pack, that will attract a lot of flows or a lot of interest from overseas bond investors, and that's something that we could expect to see over the next few years. The other factor is, of course, which was a disappointment recently, the non-inclusion in a bond index or a couple of bond indices which were talked about. But directionally, I think a lot of things have been done on the policy side to enable offshore investments. And I think over a period of time, even these index inclusion things would get sorted out. So there would be a case for a much more structural investment by offshore investors in Indian bonds as we go forward.
Right. Just in terms of macros, can you just talk to us about how it is different than the previous cycle? Why this strength despite crude going back to 100? What is the difference that you get? I'm sure you would have seen 2013, 2018. You've done a lot of analysis. What does it? Why does it make India stand out this time?
Right. So one is always, if you talk about inflation, which has again been a pain point, especially in most of the developed markets today. Even though in India, the inflation is actually above the upper tolerance band of the RBI, compared to where some of the other developed markets are, where their inflation target is 2% and inflation run rate is about anywhere between 8 to 10 if you look at the US and the Eurozone. So there is a substantial, I would say, unanchoring of inflation expectations in the developed world as compared to what we have in India today. And today, when the forward-looking estimate on inflation is closer to 5, which is more closer to your policy target of 4, there's a lot more of, I would say, relative comfort on the inflation metrics. Even though I would reiterate that we are not completely out of the woods as regards our own inflation target band. The second, of course, you talked about 2013 and what has changed today. The single biggest aspect has been the strength in our external sector account. That is the balance of payments. So we've been, I think we've always run a large deficit on the current account, but capital flows have always been funding that gap. And we've seen that over the last few years, the RBI had built up a significant amount of reserve cover. Even if you look at any of those metrics in terms of the import cover that one is comfortable with, we have substantially better than where we were in 2013. So on the external side, we've got a fairly strong balance sheet. On inflation, even though we still have a lot to cover, we are far better on relative terms compared to some of the developed markets. And the third aspect is on the fiscal account. That has always been a pain point for India. It was in 13. Even in 2020, we were relatively on the fiscal side. There were challenges which are very clearly apparent. But on the fisc, if you look at incremental data points, there is a lot of positives to take away. We've seen that over the last few years, the budgeted numbers have always been conservatively budgeted rather, and the actual run rate has been substantially better than the BE numbers. So there is one, due to relative economic growth prospects, growth rate is much better. That is the real GDP growth rate. Tax compliance is probably getting better, and that is getting reflected in better tax numbers. So even the tax GDP ratios are relatively moving up. I'm just talking about the incremental or the directional change. So on all three accounts, fiscal, which is a positive or a story that is incrementally getting better. Inflation, we are relatively better as compared to some of the other markets. And on the external sector, it is a very strong balance sheet. And I think that is what is probably differentiating our markets and giving it a lot of stability. But one should not really be complacent, because end of the day, a strong dollar and the I would say more synchronous monetary policy tightening by developed markets will have spillover effects. And I think that is something that the RBI governor in the recent policy did mention about the third shock. And that is something that financial markets need to be very, very cognizant of as we go forward. Yeah.
Right, sir. Got the point. In terms of inflation, especially the global one, which is in the US or in the Europe, there have been talks that, commodity prices are coming down. It should start to come down, but the sense is that it's still, higher than what the street is expecting. What is the sense that you get on those lines? Where do you see, what essentially is the key thing for global inflation? And once it slows down, what will it mean?
Yeah. So one of the key themes today in markets is slowing global growth. So effectively, what's happening, or very clearly, what's happening is the developed market central banks, given their constraints on unanchored inflation, they are very clearly tightening into a slowing economy. And for us, that should actually enable commodity prices to stay lower, because if your the base case remains that economic growth is likely to weaken, or you could potentially face recessionary conditions globally, that in a way should support or rather should prevent commodity prices from spiraling out of control. So from our macro balance sheet perspective, falling commodity prices are always a great, it's always a positive, but we would definitely be impacted in terms of slowdown in external growth, where trade actually slows down, and overall our potential growth over the next couple of years would be impacted. So given these interlinkages, you have to necessarily anticipate that incrementally economic growth could come off a little bit even in India. We expect that this year it should be about 7%, but FY24, the growth prospects could be slightly lower given this overall external market dynamics.
Right, sir. Got the point, sir. Thank you so much. Always great to have perspective from you. And of course, I'm sure from now till the next 1 month, we'll get a lot of global data, movements in yields, and we'll hope that you would take out time for our viewers once again when there is a substantial change in your view.